And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. The barrage of earnings are out today. And of course, as we get into tomorrow and Thursday, we're going to start getting all the big boys as well. So we'll see Apple, Microsoft, Google, Amazon. Those are all coming out this morning. A couple of interesting ones out this morning. Pfizer, which has been just a real drag of a stock ever since the COVID vaccine pandemic was over. That took a lot of revenue off their table. Stock's really been kind of dragging. They actually beat revenues and estimates. Not surprising. By the way, we talked about this before with earnings season. We cut earnings rather dramatically coming into this quarter. And not surprising, we have a near 80% beat rate. We have one of the highest beat rates of earnings this quarter for companies. Revenues, not so much. Revenues are about average in terms of the beats. So, it's not super big on the revenue side, which is interesting, right? We're killing it on the earnings, earnings per share at the bottom, but revenues are really not growing that much at the top. How does that happen? Of course, well, we buy back shares and that reduces the number of shares outstanding, raises my EPS, right? So that's how you do it. That's the magic trick of Wall Street. But McDonald's had an interesting report out this morning. They did beat earnings and estimates, as again, because we lowered the bar, but same store sales were down 1.5% over the quarter versus a 0.6% estimate. So a much slower foot traffic in McDonald's. And again, we kind of keep going back and talking about, how strong actually, right, is the retail consumer. And, McDonald's is one of those kind of stores where, that's where a lot of people go to grab a lunch or feed the kids, whatever it is. When I was raising 4 kids back in the day, we'd go to McDonald's, spend $20 to feed 4 kids. It was awesome. You can't do that anymore, by the way. It's no longer that cheap. But, that's been kind of a go-to place for fast food, right? And so when consumers get, kind of tight, they certainly start cutting higher end restaurants out, right? So instead of fast food casual, right, like Chipotle, you scale down to a McDonald's. But now even that is starting to show some signs of slower foot traffic. So, it'll be interesting to hear from, other retailers as we go forward here over the next few weeks. But, importantly, what we'll find out, I think, is that the consumer is really kind of starting to struggle here a little bit. Not surprising. We kind of know this data. But it hasn't really shown up in the economic data as of yet, right? And so we were talking about GDP, we're talking about employment, those type of things. They've been, much stronger than expected. And that's the key word, right? Expected. Because previously, economists were pretty negative on the economy, and economic data has been beating their estimates. So the economic surprise index has been rising. Now, we're starting to see economists ratchet up very sharply, right? Expectations for wage growth, expectations for the economy going into next year. So now the markets, the economists are kind of getting set up to be disappointed as we move into next year. So kind of keep a watch on that. But again, it's keep a watch on these earnings because there is a story kind of unfolding in these earnings that the economy is indeed slowing down and there is pressure on the consumer. Now, fortunately, oil prices have been declining here lately, so that's going to kind of ease some pressure at the pump. That may give the economy a little bit of boost here heading into year end, a little bit of extra spending money for the holiday shopping season. That's going to be the next key reports really to pay attention to will be the retailer reports, around Thanksgiving, around post-Halloween, Thanksgiving, and then of course December, just to see how strong the consumer is going into year end. Because that, again, as we've talked about before, you can't really discount retail sales. That's 40% of PCE, which is 70% of GDP. So again, how strong the consumer is or how well the consumer is doing is very important to all these estimates for next year about earnings and that we're going to have 13% earnings growth next year. Well, how is that going to happen if you have a weaker consumer going into next year? Because again, there's no more catalyst at the moment. All that extra money we sent people has been slowly getting drained out of bank accounts. and there's not more coming in. So we'll see how this works out. Okay, let's talk a little bit about the market yesterday. Here's what you need to know before the bell. Yesterday, the market just kind of continues to do its thing. Nothing really exciting or not exciting here at the moment. We're still sitting on a sell signal, and that's limiting upside. Now, again, I got an interesting question yesterday in chat while we were on the air. I didn't get to address it. But the question was, the market was moving up, and it's like, well, didn't Lance say there was a sell signal? Yes, I did. And there is an actual MACD sell signal in place right now. But sell signals don't necessarily mean market's correct. It just means that markets don't go anywhere. And again, what these sell signals tend to suggest is that there's more buyers than sellers, momentum slowing down here a bit. And markets can correct through two manners, which is either consolidation, which has now been going on for basically about 2 weeks. We haven't gone anywhere in 2 weeks. We had about a 6-week advance, kind of nonstop, and then the market's just kind of gone nowhere for 2 weeks now again. And that's that sell signal. That's that slowing of momentum. So sell signals don't mean that you're going to have a big correction. It can mean it, right? I mean, there's certainly periods where we have a sell signal and you get a decent correction in the markets. But it also means that the markets could just consolidate. Remember, there's always two ways to correct an advance in the market, and that's either a pullback in price or just a consolidation that allows moving averages to catch up to the actual market. That's what's been going on. The 20-day moving average continues to act as very, very good support for the market. So again, every time we come down and test that 20-day moving average, the market just continues to hold on to that at the moment. We're about halfway through reversing some of the overbought condition as well. So again, this market looks like it's just going to try to flop around. Normally, we kind of get a correction of some sort, kind of an easing of risk going into the actual kind of election, but that really didn't happen this year. We got that correction back earlier in August, and then again, in kind of in late August going into September, we kind of corrected, de-risked portfolios a bit since then. But markets have been rallying up, but this kind of consolidation is also working to reduce equity risk heading into the election. Now, one thing to say about the election coming up, which is next week, is that equity traders are very long equities and very long the VIX at the same time. And that's pretty unusual. Traders aren't really well hedged for an unexpected outcome or an unexpected event post-market. Or post-election. So there is a risk that we could see a corrective sell-off post-election, or maybe even election night, etc. So you got to be a little bit aware of that. Now we saw that in 2016. In 2016, when it looked like Trump was going to win, everybody's like, "Oh my gosh, Trump's going to win the election." Markets declined like 500 points, like immediately. We were down 500 points and that was overnight during the election process. By the next morning, that decline had completely reversed itself, and the market was up like 500 points by the end of the day. So again, this can shift very quickly overnight, and this is why you want to be a little bit hedged, going into the election. Have a little bit extra cash. I don't know how this thing's going to turn out, and I don't know how the markets are going to respond to it. The markets are very confident in their positioning right now, and that's always worries me. When markets are very confident about anything, it worries me because they tend to be on the wrong side of the boat. So something else happens from the election, you get a correction, we'll see what happens. But again, just kind of be aware that there's a bit of risk here going into the election next week, and so just kind of prepare accordingly for some potentially some increased volatility. Doesn't mean it has to happen, just potentially. All right, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn. A lot of questions from clients and prospects this week we'll get into this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Keep you up to date. After the bell today will be Google and AMD in terms of earnings. Pfizer reported this morning. BP reported. McDonald's all reported this morning. But Google and AMD will be after the bell today. Consumer confidence also comes out this morning. That's expected to rise to 99. That's still a very low level of consumer confidence historically. This, if you take a look at consumer confidence relative to the economy, it's like they're not too confident, right? But yet everything's going swimmingly in terms of economic data. However, one thing that the consumer confidence measures. Is that correct? If I say consumer confidence measures, yeah, it measures
squared.
How many measures can the consumer confidence measure? I don't know. Anyway,
Dr. Seuss.
The consumer confidence measures investor sentiment about stocks. That's the highest level on record. It's amazing. Consumers are super confident about the stock market, and which at the same time they go, my life sucks economically, but the stock market, it's all good. So. Just depends on where you're excited, I guess. Tomorrow, we'll get into a lot more of the earnings reports. Microsoft and Amazon and Apple are Wednesday and Thursday. So those are all coming up. So we'll have Mag 7 out for the most part this week. And that pretty much wraps up 80% of the earnings reports. And that's why the blackout window for buybacks restarts on Monday. Technically, it kind of started yesterday, but it really kind of goes full force on Monday because 80% of companies have reported, and then we'll get NVIDIA sometime late November, right around Thanksgiving-ish.
Is that $6 billion a day? What's the buyback amount?
$6 billion.
$6 billion a day.
That was $5 billion a day last year. It's $6 billion a day this year.
Just throw another billion on there.
Yeah. Well, we're at 900. So the announced buybacks. So I got a question. Let me say this real quick. I got a question the other day by email. It's like, how do you know how many buybacks are? Because companies announce them, right? And so companies say, we're going to buy back stock. In fact, I'm writing an article that'll be coming out about how there's been a lot of people pushing back. It's like, buybacks are a return of capital. I got into a debate with Lynn Alden on Twitter, X, whatever. And, it's like, they're definitely a return of capital share. No, I didn't get a check. Apple buys back shares. Did you get a check in the mail? No, you didn't. Right? Did you get a dividend from Apple? Yeah, you did. So a shareholder buyback only affects the shareholders that actually buy back stocks. And it's pretty much limited to insiders of companies because they know when the buybacks are being executed. So they tender their shares for those buybacks. A tender offer is a return of capital to shareholders because a tender offer goes out to everybody. So if John Penn owns Apple shares, he gets a letter in the mail that says Apple's buying, is making a tender offer for your shares at X price. And John Penn can make a choice to sell his shares back to the company at that price if he wants, or he can sell the shares in the open market. But here's the thing about return of capital to shareholders. A return of capital means that I'm getting my principal back, right? So I can do that at any time by just selling my shares in the open market. I can sell my shares and then I no longer own shares, but I don't have my money back, right? So, this is the big debate about the real value of corporate buybacks. The real value of corporate buybacks is that companies are using it and the insiders use it to redeem stock options, restricted stock units, et cetera. That's how they redeem those. And there's a deleterious effect to the overall economic prosperity because instead of investing $982 billion, which is the current earned buyback announcements for this year, we're approaching $1 trillion, $11 trillion in buybacks over the last, since 2003. We've done 11, and add this year will be 12 trillion in buybacks altogether. So we've done $12 trillion worth of buybacks. How much good could we have done in the economy in terms of creating jobs, building new companies, building new plants, doing research and development? That's 11 trillion. I'm constantly getting solicited by charities going, hey, we're trying to raise money for Alzheimer's research or whatever research it is. That's 11 trillion in buybacks that could have funded a whole lot of stuff, right? Because Pfizer's buying back shares. Boeing spent 5 years buying back shares, and then when the pandemic hit, they went to the government begging for a bailout, right? So that's my problem with buybacks. It's the least best use of capital because it only affects a very small group of people. So, but I've got an article coming out on this, so I've ranted on this before, so I won't rant on it today. Anyway.
Yeah, but 401k balances sure look nice.
They do.
Hey.
They do. Yeah, if you're one of the 25% of Americans that actually have a 401k plan, you're doing awesome this year.
You're doing great.
You're doing awesome. So, all right. Well, John, I don't want to get off onto that rant. Anyway, I kind of already did. But anyway, buybacks start on Monday. So just that's going to go at the end of the year. There's 22. So of that $982 billion in announced buybacks, 22% of those will get executed between November and December. So just kind of do the math. That's $6 billion a day into the end of the year. That's how they get to that number. That's how you know what that number is. And that's trading days, not calendar days on top of that. So there's a few holidays coming up as well. So, John, welcome to the show.
Good morning.
Glad you're here.
Thank you.
Okay.
Good to be here.
I'm done. So I'll see you after the show.
Sounds great.
All right, take off.
Let's just drink some coffee. It's good.
Brent sent me a tag this morning, says, I will always be there for you as soon as I finish my coffee.
That's right.
This is my motto.
Get your coffee in you, and I'm ready. Let's go.
My wife is very much that way. She's like, don't talk to me till I have my first cup of coffee. Just leave me alone.
Yeah.
So I learned a long time ago, don't mess with her first thing in the morning.
Yeah, Shauna likes her. She drinks about a half a cup, just enough, kind of to prime the pump, and then she's ready. She just needs about a half a cup, and then she's ready to go. Unlike me, I need at least two.
Yeah,
to get the engine fired up. Then I'm ready to go.
It's interesting. Before I met my wife, I never drank coffee.
Really?
I never drank coffee. I mean, I didn't drink coffee my whole life until I met my wife, and she drank coffee. And so I was like, "That's terrible. That tastes terrible.
Tastes like dirt.
Why are you drinking that?" And she's like, "Trust me. Once you start drinking coffee, you'll never go back." And you're like, "Damn it."
Yeah. So with our girls, our two daughters, our youngest daughter's a coffee drinker. She's 22. Senior in college, and she started drinking coffee probably about 2 years ago. Our oldest daughter's still holding out. She just turned 24. She's like, Dad, I'm not going to do it. I'm not going to do it. I'm not going to do it. I was like, yeah, you will someday.
Yeah.
It'll happen.
Yeah.
But she's holding out. Yeah. We'll see.
I held out for a long time.
Yeah.
And then my wife sucked me into the dark hole of coffee.
Never went back.
So, exactly. Number one concern I'm hearing right now is how will the market behave if we have a contested presidential election? It's a good question, John.
Yeah, that is. So over the last, as we're getting closer to the election, it's hard to believe it's here right around the corner. That's been the number one question that I'm getting as of late is, what do we expect the market to do if there is a contested election? Is there any way to kind of have an idea there? or I think folks are just hoping for an election where whoever wins, the majority of the win is so great that this doesn't get to be some long contested, drawn out process. Because as you know, markets don't like uncertainty. We want an answer, we want a decision, and then from there we can know, okay, here's who the president's going to be, here's what their policies are going to be, and how do we kind of adjust portfolio strategies from there. Yeah. I think folks are really worried about this gets to be some long, drawn out ordeal.
Well, and again, where this goes potentially, and look, I have no idea how this is going to turn out. But there is a couple of very interesting little tidbits for this election that we haven't had, right? So if Trump wins the election, Kamala Harris has to certify the election.
That's right.
Right? Because she's vice president.
That's right.
And that hasn't changed. So she's going to be the one that has to certify the election. There's a risk that she might delay that. I'm not saying that she won't certify it, but if she wins the popular vote and he wins the electoral college vote, there could be a bit of contest relative to certification of that election. Again, I don't know. I'm not saying that's going to be the case. I'm just saying that there's some interesting tidbits of things that are running around. And we've seen, look, and we're not talking about just the last election. You don't have to go too far back to see contested elections previously. Gore-Bush election back in 2000. That you may be too young to remember this, listening to the show, but if you were around, it was all about the dangling Chad.
Hanging Chads.
And so those are the Chads are little punches on the voting cards, right? And they weren't completely punched through, and so they were debating for about 3 weeks over, do we count that ballot or not? Because the ballot wasn't punched all the way through. There was these hanging Chads on these ballots. So do we count them or not? Because if we don't count them, then Gore wins the election in Florida, which swings the whole state, right? And so this was all really kind of focused on Florida at the time. I do those bits of history, by the way, to remind myself I don't have Alzheimer's yet. So that's like just a mental check. I try to remember that. I can't remember the guy name that produces the show, but he's over there. So it'll come to me in a minute. But yeah, so we've had elections before where there's contest, and just the risk of a contested election this year, I think, is probably pretty elevated.
I do too.
How markets respond to that, I don't know. Because here's the thing that I do kind of see right now is that if you take a look at equity positioning on stocks is at a very, very high level. And investors are very long equities, both professional and retail. Gold is very long. The thing that sets the price of gold is futures trading. That's what sets the price of gold. We have not had gold traders this long gold in like 30 years. So everybody is very long assets going into this election expecting an outcome. The risk, as we talked about earlier, is what if something else happens that we're not expecting, right? And that's what I was saying, as investors heading into this election, there's no way to tell what the outcome is going to be, but I would expect a pickup in volatility, right? So, okay, we'll come back and answer a few more questions after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife and I are in a huge fight. She says I absolutely don't love her anymore. And I said, honey, that's not true. I just said you can't put the Christmas tree up yet. It's not Halloween.
Does she want one tree or both of them up now?
She wants them both up. Oh. We compromised with Thanksgiving stuff on the table and Halloween stuff in the living room.
The Real Investment Show podcast. Same show.
Yeah, I'm surprised she's not wearing her Christmas sweaters yet.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, and it's interesting. So we're just talking about, what happens potentially, post-election. And I don't know. What I do know is that everybody is very, very long equities. They're very long risk in general. And this has been a very interesting market because all asset classes that are risk-based, Bitcoin is up 51% for the year, 52% for the year, something like that. Gold's up 23% for the year, right? If you take a look at stocks, they're up 22% for the year. So, everything's just been rising together in terms of risk assets. Safety assets aren't, right? So I'm selling safety to buy risk. And that's all that's occurring in the markets right now. And there's a huge bet that as we go through the election, everything's going to be just fine. And again, that's the concerning part is that, and look, we're long risk right now too. So, we're right there in the mix with everybody else because the markets are going up, right? And so we have to be invested right here in the heart of earnings season. I've got, we own Google, we own Meta, we own Apple, we own Microsoft. Those are all reporting, right? So if they have good reports, the portfolio is going to make some money and that's our job, right? But I do worry about the risk on the other side of this when everybody's on one side of the boat. I kind of like assets that aren't being loved right now. And right now, nobody loves bonds, which is why I took a long position. Personally, I took a long position in bonds with some call options for the end of the year. I think post-election, we may see bonds rally very strongly. So, and particularly that's the case if there's any kind of uncertainty, right? You'll get this risk-off rotation. So we'll see what happens. And I don't have the answer. I don't know what's going to happen. But, I do think it's interesting, this kind of, and even for us right now, it's a little bit of investment analysis by paralysis, paralysis by analysis,
right?
Yeah. And, I think we're seeing that with a lot of, prospective clients as well, is that they just don't know what to do right now.
Well, I think there's always, sometimes it's easy to come up with a reason not to invest. Mm-hmm. And in this year, especially at the beginning of the year, for folks that I was visiting with that were kind of prospective clients at the time, they were just very concerned that this is an election year. What's going to happen, and how will the market? I'm going to wait till after the election. I'm going to wait. Plus, I was, enjoying, at that time, 5-ish% risk-free yields. My goodness, I think I need a third cup of coffee. Risk-free yields. I'm going to slow it down, folks, and their money market. So, if I'm getting 5% risk-free, why should I put any money in the market? I don't know what the outcome of the election is going to be this year, and little do they know that from a presidential year, this has probably been one of the strongest years so far. The strongest year in a presidential election year so far?
Yep.
So you think about, you look at what the markets, all asset classes have done, so far this year. It's been really, really strong. So, but I think sometimes, Lance, folks get confused, and I think they think that investing needs to be an all or none decision. I'm either all in or I'm all out. If you would have just nibbled a little bit and put some of your money into the market for it to grow and for it to work and to try to, fight inflation and keep your purchasing power and have your money working for you, that doesn't mean you have to go into a 100% stock portfolio. Right. I know you just mentioned that we are long equities, but we're not 100% in equities. We've got enough exposure so that if markets do well, hey, you'll benefit. But if there is a little bit of volatility here, through the election or maybe even after the election, with the exposure to treasuries, and by design, we're holding some additional cash on the portfolio right now. If markets have some healthy pullbacks, we can use that to be opportunistic, right?
That's right.
So it doesn't need to be an all or none bet. So I think sometimes if you just kind of get started and get some money to work, again, you have to go back to your risk tolerance and see just really what makes sense for you. But I think sometimes we kind of get in our own way by overanalyzing and then, I'm just going to wait. I'm going to wait for the perfect time to invest. There are folks that I visit with today that they've been waiting for the right time to invest ever since they pulled out of the markets back in the great financial crisis in 2007, 2008, and they've never gotten back in.
Right.
And they've missed a tremendous set of opportunities along the way. That doesn't mean that, it's always been rosy and it's always been perfect. It doesn't mean when you put your money into the market, it always goes up. You have to accept that there's going to be volatility. When you put your money to work, markets don't always go up, and you've got to have that realistic understanding that markets may pull down too. But, what's the right balance? How much to put in equity? So again, in the short version is it doesn't need to be an all or none decision with this stuff.
That's right. Yep. Well, no, and this is again, as I said, we tend to get all kind of wrapped up in our own analysis of whatever it is, and it's like, oh my gosh, I'm so worried about this. So, and I can find all these reasons why I shouldn't invest in this or I should invest in that. And the problem is that doing that, and this is why the other day when we were doing technical analysis, we kept it very, very basic here on the show, because it is really easy with technical analysis to get a whole bunch of different messages all at once. As I said this morning, right? Right now we have a sell signal in the markets, but markets are doing okay, right? So it's like, I don't know what to do, right? You got a sell signal, but the markets are doing fine. That can happen, right? But you start adding on all these other indicators like average true ranges and Williams percent R and stochastics and price momentum oscillators, all these type of things. We can just keep piling on these indicators, and they all start giving you different messages. And then you go, well, now I don't know what to do.
Yeah,
right.
So I'm not going to do nothing.
Right.
And that is a strategy. Doing nothing. That is a decision. But but then you look back and you go, golly, well, I'm going to go back and look at the market. Yeah, if I just would have invested right there. Oh, if I could have just invested right there. Well, looking back is always easy in hindsight. But now here's where you are today. You got to start looking forward, right? And so again, it doesn't have to be an all or none decision with this stuff.
That's right.
Yeah,
absolutely. And again, this is just as we just kind of work through, and this is why we just talk about these things every day. And again, it doesn't matter kind of what asset you own. For instance, we have a portfolio that we run called the all-weather portfolio.
Yeah.
It's got about 9% of it's in gold, which is doing fantastic this year, right? That portfolio is doing way better than it should be doing, because the whole reason it's called all-weather is it's got high dividends. It's got high-quality companies with big dividend yields as part of the portfolio, so it generates an income return. It has some short-duration fixed income. It's got gold. It's got some other assets. And what it's meant to do is be a low volatility portfolio that just generates a rate of return every year, but has very low volatility to it. So in the event of a crash, right, in the markets, it actually does well because of the way it's kind of self-hedged through the assets that it owns. That thing is generating returns this year. It should not be generating, right? And that's just because this is, everybody's piling into risk assets. So you've got all the asset classes are all going up at the same time, and that shouldn't be the case. Yeah. And that's the risk to the markets. But see, we get very overconfident about that. It's like, oh man, this is just going to keep going forever. And it's not. And, and this is why, we make notes in here about positioning, because when everybody's positioned on one side of the boat, that's when the thing becomes more risky in terms of future returns, because you're eventually going to get a reversion to the mean, and that happens with all assets. And this is the one thing we forget when everything's going up. We always forget that everything reverts to the mean eventually. So don't forget to take profits. And that's the kind of the key lesson, right?
No, I agree. So another question, an email that I received was talking about that belief that things will just continue to go higher, right? And it just was an email that I received from a client. I have a belief that bonds are not a good investment, as I do not need income. Hard assets are going to prevail in the future, not just gold and silver, but minerals, mining, et cetera. What do you think? And so I find the timing around this email interesting, because as of late, interest rates on the long end of the yield curve, on the 10-year and the 20-year, earlier this morning I was looking at the yield on the 10-year Treasury. It hit 4.3, I think earlier this morning. So it's definitely ticked up here in the near term, which has put downward pressure on bond prices. So you're seeing bonds pull back here in the near term. And it's just interesting that, as you mentioned, gold, this has been a good year for gold. So now it's like, well, our bonds, I'm just going to get out. Am I going to get out of bonds here and just go all into metals? I mean, is that a smart decision?
Well,
right?
Yeah. And again, there's a lot of challenges to that as well, because, again, when you talk miners as an example, they are the worst allocators of capital, right? They are terrible managers of their businesses when gold is good, right? And you have to remember that gold's an input. So gold's an input. As the price of gold goes up, the price of their wages, the price of their, cost of mining equipment, all, the cost of extraction all goes up with the price of gold, because everybody wants to be paid more for doing the work. So they're terrible managers of capital. And so, where gold doesn't have any fundamentals, it's strictly based on price, right? It's just the price of what I'll pay for it today versus the price I'll pay for it tomorrow. Gold miners, as a good example, those are all based on fundamentals. And so you really need to do your homework on, I'm not saying that gold miners are bad.
Right.
I'm not saying don't own them, but you really, there are good gold mining companies and there are really poor ones. And so you need to make sure, look at your debt ratios, look at, their fundamentals, look at their return on assets, return on investment, return on mining, all those type of things, to make sure that they're running their company well. And when you start doing that homework, you're going to find out that a lot of these companies don't perform really well in terms of being a company. But the other big thing is when it comes to commodities are very economically sensitive, and you can't have there's been a lot of data out, people coming out saying commodities are about to have this huge run. Not necessarily the case, because we're a service-based economy now, not manufacturing. And commodities are very economically sensitive. So if economic growth is slowing in the future, as it will be, and again, so now you go back to your debts, your deficits, all those things that slow economic growth, your demand for commodities decline. And that's why really over the last 50 years, commodities have just pretty much traded in line with economic growth, because they're a function of the economy. All right, quick break. We'll come back. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just a quick comment. So we were talking about commodities a second ago, and so I just did a quick look up. If you invested $1,000 into the CRB index 50 years ago, you've made 30% on your money. So in other words, you invested $1,000, it's worth $1,300 50 years later, right? So that's my point about commodities, which is they are very, very economically sensitive and they're hugely volatile. What's going on right now with commodities and gold and, basically everything we've got going on that side. And again, there's a lot of this commentary around the reason that I'm buying the stuff is because the U.S. is about to go broke and, the debts and the deficits and the deficit spending. And so that all drive these prices higher. This reminds me very much of 2007 when we were having exactly the same conversation. And we had big surges in commodities. Oil prices were surging off to the moon because we were running, I remember it was peak oil back then. And then all that changed, right? So just, the whole point is, and again, we're long these assets too, and, our all-weather portfolio. So we've got a portfolio that's long these assets. We're watching these things very closely. And again, just, as important as it is just remember, markets are all about psychology. And when psychology shifts for whatever reasons, when the meme changes for whatever reason, then money flows will go into another direction. And this will end eventually. So just not necessarily this year, not necessarily next year. I mean, we could have boomer years for commodities and gold miners, et cetera, for the next year. It could be next month, right? So just be careful. Again, as always the case, just always be mindful that in particular with commodities, hard assets, gold, those type of things, those are all traded on futures. So as opposed to a stock or a company that has underlying fundamentals or a bond which has underlying fundamentals, gold has no underlying fundamentals. It is simply, at the end of the day, a rock that we assign value to. And it's okay that we do that. But one of the big issues is that I hear this comment a lot is that they go, well, yeah, but if the economy ever collapses, we're all going to go back to gold. What if we don't? Right? What if the economy collapses and we all trade bottle caps? Right? Because there's bottle caps, they're rare at that point, And that's the thing that people choose to trade, right? So you don't know, and this is the point, is that we think that we'll go back to gold in the event of an economic collapse, but what if we don't?
Yeah.
Then you have a rock that's yellow, right? So, and I'm not saying that's going to be the case, but see, these are the fallacies to the thesis in a lot of cases that and trust me, in the event of an economic collapse, the last thing you'll be worried about is whether you have gold or not. It's going to be more, do I have bullets, right, to protect my family? Yeah. Do I have food? The good thing is that most people won't live more than 7 days after an economic collapse. So that just solves a lot of problems. But, you just have to keep in mind that this is all about positioning in the futures. And and as humans, we want to assign rationale to all these things because that's how we justify price in our mind, is that we assign a rationale to it. Just remember, it's an asset and you trade it accordingly. And again, we're not anti-gold at all. We have positions in it. We have portfolios that own it, and that's their job. That's our job. Our job is to invest in assets that are going up. We're just reminding you that there's risk to all of these assets. So don't take anything that we say here as like, oh, they're just anti-gold. No, we're not at all. We're not anti any asset. We're all for every asset that goes up in price because that's our job. That's what we do.
Yeah, I mean, many of the individuals and families that I work with, they have a allocation to gold, silver, to precious metals and it's part of their overall investment mix. But it's all within balance, right? It's just a piece. It's a diversifier, and sometimes they need help figuring out what is that right allocation. Let's look at the big picture and what makes sense. And hey, John, is this type of an allocation to gold or silver? Is it healthy? And I can look at it and go, yeah, you've got the right amount here, and it's all about balance. But it's not hey, I've got 40, 50, 60, 70, 80% of my portfolio in precious metals, because to your point, if it moves against you, you don't want to be on the wrong side of it, right? It's all about balance. So if you have, like Lance is saying, we don't want to bash gold or silver. Many of the folks that I work with own a piece of this within their overall portfolio, but it's all comes back to balance, right?
Yeah. And again, silver is an interesting one too, right? And because there's a lot of hype, and I'm getting tons of emails about silver, and silver's going. Remember, if you don't know the story of the Hunt brothers, I highly encourage you to go and study history about the 1980s and the Hunt brothers relating to silver. There is what my dad used to term a crap ton of silver in the world, right? Gold is one thing, right? But silver is an entirely different issue. There is silver everywhere. And the real quick synopsis of the Hunt brothers that they tried to corner the silver market back in the 80s and were driving prices higher. And every time prices went higher, they bought more and more of the futures contracts on silver, trying to corner the silver market. What they didn't count on at the time was people then going and selling their grandma's silverware, scraping the backs off Polaroid film, which had silver in it. And there was just so much silver coming into the market to get sold that they could never corner the silver market. And they eventually went bankrupt trying to chase that trade. But it's a very fascinating story about silver in general, but about the silver market and how futures work, et cetera. And again, this is one of the sides of gold prices as well, is that there's a lot of gold out there in terms of supply. Gold, people have gold jewelry, they have et cetera. And when prices reach a certain point, they're going to sell it at some point. You're going to reach the point that people sell their gold. And then when gold supply comes to market, those long futures have to get sold, right? Because they have to start taking delivery on those futures. So that's why these things cycle over time, and just be aware that you're going to go through booms and busts on a regular basis. So
yeah. Something else too that I'm seeing, Lance, is that folks are receiving emails, or they're getting solicited, or they're getting quote unquote advice from other advisors or other entities, and they're starting to kind of these other entities are dangling out these higher yields to them. Here's a way to lock in some yield. Here's a way, because interest rates are on the decline. Short-term interest rates are coming down. So folks you've got your money in your money market, CDs, T-bills, whatever that is, those are now all coming due, and now you're having to replace those at lower yields. So I received this question from a client last week. The client received an email about a quote-unquote bond account where they could place their money, and in big, black, bold letters on the email, it said, the title of the email read, two ways to secure your yield. One was in a portfolio of using treasuries.
Okay.
And the other one was, well, here you can lock in a 6.8% yield with using a portfolio of high yield bonds.
Right.
Well, high yield bonds. Well, what could be wrong with that, right? Or what is a high yield bond?
Well, it's a bond that has a high yield on it.
It's a bond that has a high yield.
It's
so
exactly what it says.
That 6.8 looks pretty good when I take a look at what my money market's paying or what short-term treasuries or even longer-term treasuries are paying. But high yield is just a fancy word of saying junk or non-investment grade bonds. So you have to watch out for that. And I have a feeling that more and more folks are going to start, as interest rates start to decline here, I think there's going to be more of this pushed out there. And you kind of have to watch and kind of look under the hood on what do these portfolios really own, right?
No, it's true, and again, high yield has become a marketing acronym for Wall Street, for junk bonds, right? And it's, if I came to you and said, hey, I've got this really great junk bond you are to buy. It's CCC rated. Yes, they're on the verge of bankruptcy, but it has a 9% yield on it. You're going to like, Lance, you're crazy. I'm not buying that, right? But if I come to you and say, hey, I've got a 9.8% high yield bond, you go, okay, that sounds interesting. Mm-hmm. Tell me more about it, right? Yeah. It's all about marketing. And that's how they sell you stuff, right? Again, at the end of the day, you're the cannon fodder for Wall Street. But you have to be careful. Again, this is why it's so important to understand fundamentals of what you own. What's underneath it? Do I have an asset in my portfolio that has no fundamentals, but it's only going up in price because everybody's chasing it? That's okay. There's nothing wrong with that. Just understand that at some point, somebody's going to stop chasing that and the prices are going to reverse. And when you have something with no underlying fundamentals, it has no revenue, no earnings, no growth, no matter what it is, those reversals can be very large. And so that can happen. So understand, kind of what you own, and understand that if I have something that has fundamentals, there's a limit to how much that price is going to rise based on the underlying fundamentals as well. So, but there is actual underlying value to it. So this is why real estate is always, if I buy a piece of real estate, there's always a base fundamental value to a piece of real estate. The value of the land is always going to be there. That, the house can burn. I buy a rental house for $120,000. The house burns down for whatever reason. I have no insurance because I was stupid. There's still the value of the land. The land itself may be worth $50,000, $60,000, $70,000, right? So there's always a base value. There's a minimum. If something has a fundamental to it, there's a minimum value it will trade at. So you can judge these things. But this is why everything you look at, when somebody promises you a really high yield on something, really understand what it is that you're buying into, because there is, the higher the yield, it's simple, the higher the risk. That's it. Mm-hmm. All right. John, thanks so much.
You bet.
I think we pretty much went around the whole tree today.
I love it.
So, all right. Be sure by the website, like this channel. We'd appreciate it. Smash that like button for us. Help us out with the Google algorithms. That does help us a lot, and that does help us kind of keep growing the show and reaching more people. We appreciate it. Get by the website. Our latest article is out on the website today, realinvestmentadvice.com. Follow us on Substack as well, at Lance Roberts. It's all there for you. Whatever we can do to help you, we're happy to do it. realinvestmentadvice.com. See you back here tomorrow with Danny Ratliff.